Good morning, all. Good morning, all. All right, make sure you're there. My name's Jay Hooley. I'm chairman and CEO of State Street Corporation, and I'm thrilled to be moderating the panel here this morning. You've seen the title of the panel, Patient Capital in an Impatient World, and we've got, I'm surrounded by several of the elite pension fund managers from all over the globe who are going to engage in a debate around how patient is capital and what's changed since the global financial crisis. But before we engage in the discussion, I do want to introduce the panelists. First of all, Jagdeep Bachar. Jagdeep is over here. Jagdeep is the Chief Investment Officer and Vice President of the University of California, where he's responsible for overseeing $90 billion in assets across defined benefit, defined contribution, and also an endowment plan. As Treasurer of North Carolina, Janet Carroll oversees more than $90 billion as well in pension investments for more than 900,000 teachers, firefighters, and public employees. And she's only one of 4 sole fiduciaries overseeing these plans in the United States. Britt Harris, to my left, your right, Chief Investment Officer, overseeing $130 billion in assets for Teachers Retirement System of Texas, one of the 25 largest investment funds in the world. And beside Britt, we have Hiro Mizuno. Hiro is the Executive Managing Director and Chief Investment Officer of Japan's Government Pension Investment Fund, also known as GPIF, the world's largest pension fund with $1.2 trillion in assets. And to Hiro's right is Ron Mock, who's the President and CEO of Ontario Teachers Pension Plan with over $160 billion in assets. These institutions collectively represent $1.5 trillion in pension funds managed across the globe. So let me set up the discussion today. Since the global financial crisis is probably a good place to start, these folks are under a lot of pressure, both on the asset side and the liability side. If you look at the asset side, the historic low rate environment has put tremendous pressure on the traditional management of a pension scheme. Secondly, liability, aging populations, increasing lifespans. And then the third dimension is regulatory pressure to close the pension liability gap. So the pressures are obvious. They've been more acute since the global financial crisis. So how have these pension systems reacted? All a little bit differently. And I think you'll hear through the course of this morning's conversation that they're all different pension schemes in different places with different starting points, and they're all adapting in different ways. But I just say risk appetite has probably expanded as a general theme. I'd say in many cases, time horizons for investments have come in. And I'd say the third is just creative approaches. And so my hope today is, in addition to you understanding a little bit better each of these individuals and the pension systems that they oversee, is to get a sense of the creative approaches that are being applied in this particularly difficult period. So let me just start out. I want to introduce these individuals, and more importantly, just give you a sense of what their investment portfolio looks like, and just as a point of reference, again, post-crisis, how they're thinking about asset allocation, what's changed, and what is on the horizon. Jagdeep, why don't you kick us off?
Thank you. So post-crisis, we've certainly benefited from being in equities, and our asset allocation today, and the thinking in the last year that I've been here at the University of California, is shifting more towards how do we think about risk factors and risk allocation as we redesign our asset allocation. I manage a pension plan as well as an endowment, and in both cases, we've certainly had the benefit of being in the public markets. And I would say even on the endowment side, being in the public markets has been very helpful for us relative to being in the private markets. But when I look today at almost any asset class, in fact, every asset class, it's hard to justify continuing to increase that equity allocation. So the shift for me and for the organization is around moving towards thinking about risk factors and allocating risk.
Great. Janet?
North Carolina has always had a pretty conservative portfolio in comparison with our US pension peers. We had 30+% in fixed income. We have dialed that down, and we're trying to replace it with fixed income-like returns. So we've turned to core real estate, core plus real estate, real assets, credit just in general. And again, yeah, we've also benefited from the equities, although we've had a lower allocation, and now we're building out the alternatives. I will say, because we are 95% funded in our pension plan, our long-term perspective is, we don't want to completely dial up the risk. So we'll take advantage of some of the opportunities, shift the assets, but not in a dramatic way. We'll still probably remain more conservative than the typical pension.
Great. And Britt, you've been quoted as having a 25-year time horizon. So anything changed for you in the last 6 or 7 years?
Nope. Only our time horizon's probably gotten a little bit longer. So I think the thing that everybody needs to remember is that, we're just illustrative of everybody. In 2009, our portfolio was $67 billion. Today, our portfolio is $132 billion. And that's after paying out, net $20 billion or so. So we made $80 or $90 billion, in the last 6 years. So the thing that we had, I think mostly you don't learn anything new, you just relearn what you forgot. The first thing is that, people are not well diversified. They're diversified on average, they're not diversified for specific events. We try to be diversified for specific events, so we diversify by economic outcome. They also forgot that there are cycles, and there's one part of the cycle where you rely on IQ, and there's another part of the cycle where you rely on courage, and you make more money from courage than IQ by a lot. I think people are now, but with the oil situation now, people have relearned that as well. And they learned that agency structure is actually critically important, because controlling your emotions in a difficult time, is the key to success. So people who learn those three things from the last cycle have benefited greatly going forward. And just understand that you really have to think at the second derivative level about your diversification is important. And finally, the one thing we probably have added in, which I think everybody would, is monitoring for bubbles. So we are much more cognizant of monitoring for bubbles than we were before.
Great. And Hero, I think maybe within the last year you've joined GPIF. The world always looks to a $1.2 trillion pension fund, particularly on the back of Prime Minister Abe's new plan and an asset allocation shift. So a little bit about what you're thinking?
Sure. As some of you probably followed that last October, we announced probably the most drastic change in asset allocation in the history of pension management. So we now double our allocation to equity from 25% to 50%. But in the past, we navigated very well through the financial crisis, pretty much accidentally, because our fund was mostly in the JGB and the foreign bonds. So if we look back from inception, we reported a gain of about $400 billion. So we actually outperformed all our peers by being in a safe investment. But given the Prime Minister Abe's policy, new economic policy mix, and Mr. Kuroda, Bank of Japan's monetary easing, we realized the probability. Of course, we don't bet 100% on the success of Abenomics, but we realized the probability of Japan finally getting out of deflation is becoming significantly higher. So we have to prepare for that, the new stage of economic cycle. So we take that into account, and our investment advisory committee agreed to increase our exposure to equities to prepare for sort of prepare ourselves from the long deflationary period of time to modest inflation situation. So we have been doing the big asset rebalance since the last October, and I'm aware that a lot of people are actually trying to follow where we are standing in the process. At the beginning, we had a big concern that how we could possibly reduce our the huge exposure to Japanese government bond, but it just coincided with the Bank of Japan's monetary easing. So we luckily have a big buyer. So you should be able to follow where we are standing, like with 3 months or 4 months, the delay. But we are in a steady, making a steady progress with the rebalancing. But we really trying to achieve the portfolio mix, which is, I think, less vulnerable to possible inflationary, the conditions in the global market.
Great. Thanks, Hiro. And Ron, from Canada, from Ontario, what's changed, or how is your outlook any different today than it was 5 years ago?
Ontario Teachers has always, first and foremost, managed everything we do with a view through our liabilities.
Yeah.
What are our liabilities? What's the maturity profile of our pension plan? What are the inflation characteristics? That defines everything that we do, have done, and continue to do. And so we don't move our core asset allocation around all that much. What we do is we know our rate of return profile that we're after. We have a core portfolio. And then since we operate globally with a lot of global partnerships, we really focus in on how can we innovate and create new types of investments to meet our liabilities through time. And so you won't find us moving from stocks to bonds based on our sense of valuation from one year to the next dramatically. The core portfolio defines our long term, our duration, the teachers whose pensions we manage. We know that we have to deliver retirement income for generations to come. And so it's with that in mind that we set up a core asset mix, and then we look at private capital, infrastructure, real estate, bonds, equities, and all points in between on a global scale in order to satisfy those liabilities.
Great. So there's at least one common theme, which is a move, and you can call it patient, or some have been there, away from more fixed income to equities, and you hear the alternative word come up, I think, across the board here. So my question for the panelists, given that the nature of this conference draws a lot of alternative managers, and alternative strategies seem to be in great demand around the world. You're competing for space with sovereign wealth funds and other forms of patient capital. What kind of innovative approaches, or how do you invest in alternatives broadly? What techniques, what strategies have worked for you? Who wants to jump in? Britt, you want to jump into that?
Sure.
And go to Ron?
I actually think this space, real estate, infrastructure, has gotten a little pricey these days. I think the low rate environment has actually pushed people to seek higher rates of return. They've looked at the success of owning real estate. Clearly low interest rates have driven asset prices up. And so a lot of money in the last 5 to 6 years has really crowded into this so-called broadly defined alternative space. We're actually finding it too expensive right now. And in a lot of our bidding and auction processes, we're missing because we just won't pay up for it. When we've got interest rates this low and discounted cash flows coming through at this kind of level, we find it way too expensive. So from our perspective, while we're very, very committed to it on a global scale and have investments on a global scale, we're finding that it's time for us to step back. And in fact, between asset classes is where we're finding some of the most unique and interesting deals today.
A couple of examples between asset classes.
Well, perfect case in point, the UK lottery, or the Irish lottery, which we own. When you look at the UK lottery and the Irish lottery, we actually own them, it's a very stable cash flow. It's a fantastic rate of return for us. But more importantly, while we're managing these lotteries, and we now have a complete platform around them, we're able to increase the efficiency through technology, all the kiosks, the ticketing. And what happens in a situation like that is we can increase the contribution to governments in terms of their good cause money that they want to pay out for their charities. And so we look at that almost as an infrastructure asset, but it's not a train, plane, automobile, or toll road. And so we look between asset classes now when things get expensive.
Yeah, so let me just, I'm going to challenge your notion, just
Okay.
first of all, that more money has gone into equities, because surprisingly, the highest allocation to fixed income in the history of the institutional markets is right now. But you're also right that there's also been around that this spread into, into alternative investments. What people forget about folks like us that are in the table and around up here, and those of you who are out there, is that we are some of the biggest return-seeking operations in the world. Our operation is supposed to make $5 million per minute. Can you imagine what Hero's operation is supposed to make, per minute? And we are also the strongest hands. I mean, we collectively, not we personally, are the strongest hands, in the marketplace. When you talk about long-term patient capital, we have 4 huge advantages. One is we're huge, we're large. The second is we are long-term. 25-year time horizon is, that's the duration of our liability. We are not levered, and we have massive amounts of liquidity. So these types of organizations are the strong hands. It's not the hedge funds, surely people know that by now. It's not the hedge funds, proprietary trading, their operations, or any of those kind of things. These kind of operations are the strong hands in the marketplace, and we benefit, and the people who invest with us benefit when times are bad, because we take market share from everybody else with regard to future returns. The response in a low interest rate environment at the end of a six year, we're 6 years out now, is pretty simple. Kind of like you don't have that many options. Increase your equity exposure, probably after a market decline, to 80%. You can spend some of your liquidity premium. We're talking about it's kind of expensive right now to spend your liquidity premium. Most of us have massively excess liquidity. You can leverage your bonds, thus the massive proliferation of risk parity strategies and things like that, as long as you do it in a very well-diversified way. You got to control your expenses, because there is no margin of safety, above your return. And you absolutely have to be certain that your agency structure is A-rated, and the people that are investing are A-rated.
Excellent.
So,
Jagdeep, let me, I just wanted to invite you to jump into this. You've been in your role a year, maybe?
Yes.
And you've gone through a transformation, I'll call it, of your teams. And talk a little bit about, if you will, your view of alternatives. And then let's bridge into a little bit the talent question.
certainly. So I think when we think about alternatives, they come in different flavors, and every one of us in the institutional investor space has different organizational designs.
Yeah.
So it isn't a one-size-fits-all, and I think we need to be very careful of that to begin with. The second part I'd like to talk about is sort of the supply of capital. In the last decade, what we've seen is almost once a month, there's a new fund that's being created somewhere in the world with billions of dollars in a clean piece of paper. And what they've done is they've looked at the best practices around the world, and many of my colleagues here are the leading practices on the planet. And they look at these practices and say, alternatives have played a role in the asset allocation, so let's also do the same thing. And in that context, what you're finding is just in the last decade, all of these firms, I'm referring to sovereign wealth funds and other pension plans and institutional investors around the world, they're putting in the best governance practices they can put in place, they're paying their people the best they can, and then they're accessing the best opportunities because they're willing to write big checks and do it in ways that are the most creative, where they're willing to stay for the long term, however long that might be, and they're thinking about things not just in terms of a fund structure, but they're exploring things like being evergreen in nature. So when you add all of these things together, there's a huge influx of capital. The supply of assets is limited.
Yeah.
I mean, we now have 5,000 private equity funds out there, probably more private equity funds than public equity companies publicly traded companies out there. We have 8,000 to 10,000 hedge funds out there. So you've got a limit. You've had a growing supply of assets as well. But still, it is a pretty tough thing to try and access all of these. How do you pick from this list? So I think we've all tried different strategies, and Canada has been leading edge in terms of what they've done on alternatives. But what I find is, for me, in the context of the University of California, I do think alternatives play an interesting role in our asset allocation, especially when you think whether you're a liability, a stream that you've got to manage to, or a future endowment that you have to pay out for. But in both cases, I think we have to be sensitive about how we access the alternatives. The first question I ask is, I'm looking for opportunities, not alternatives. And in opportunities, what I need to know is, can I access them in the public markets or the private markets? And I think that's the first question we should all think about, because just because it looks like a private equity fund doesn't mean it's the best way to access the opportunity. So in that context, I think we should think of organizations that are designed to focus on where you want to be investing your money thematically and strategically, and then figure out the best way to access those opportunities, however that might come. I like funds. I like hedge funds. I like private equity funds. But I want to do it in a way that's aligned with my interests. And that alignment of interests boils down to fee structures, risk and return profiles. I want to be able to know what I own. I want to understand the transparency and the risks that I'm taking through a third party. And it's the combination of all of these things that ultimately should lead to your choice of how you access these alternatives. But the competition is huge. And I think we need to rethink not just blindly following the leading practices in the world, whether it's the pension or the endowment space, but fundamentally asking, how is it that we want to earn return in a diversified way in this low return environment? And that's how I think about it.
Yeah, so let me just pick up on the supply-demand imbalance. You know, there's a great demand for higher earning assets. The supply, one would argue, is limited or overpriced. Pick your option there. Which to me leads back to a little bit of a question of risk management and talent. You know, how has risk management evolved so that you've got a better sense of what you own, what the options might be? Maybe Janet and Hero might, jump in on this one a little bit. How do you view risk management today, and how is the talent piece connected to that in your organization?
So definitely, like University of California, took a closer look at risk management after the '08 debacle. And we ended up partnering with SAS, this software company that is located right down the street from me, conveniently. And we went with them because we wanted to be able to build a customized risk management program to track every position we had globally. Create our own set of metrics, which I think will help with thinking about long-termism and what are the benchmarks and how do you think about that in a portfolio. So that was our risk solution. The other issue on talent, I mean, one of the ironies of U.S. pensions, and Britt, you talk about it being the strong hand in the market, and you have this massive pool of capital that's long-term, and yet in the U.S., because of politics and governance, we are massively starved for resources and can't do what the Canadians and some of our peers, I don't know what size of the team in Japan is or will be, but it is so ironic to me that we have these huge infrastructure needs and we just can't tap it because you've got, in my case, 25 people managing $90 billion. I mean, in what other context would you have, and with salaries that when I started, I had a guy running a $30+ billion portfolio making $80,000 US a year. That's just a setup for some bad things to happen. And I have reformed that, and we now have pay equity. I've got 10 new positions coming on. That was years of work with our legislature to get them to get beyond the ideological idea of small government. But I'd say that is the big opportunity for the North American pensions is to try and insulate these pots of money, to give them the resources where they can really maximize their returns and the global influence and things we want to impact with that.
Janet, if I can just jump in on that, I think that's an absolutely perfect point. The Canadians, there's 8 funds north of the border that aggregate $1 trillion, and they're all sophisticated infrastructure investors around the world. And they're dying to come into the US to help fund the infrastructure needs that are there, whether they be brownfield or greenfield. And we've been working with the government because there are impediments to us coming in to actually do that. But it's absolutely true. With these pools of capital that over the last couple of decades, sovereign wealth funds and pensions that have grown untaxed, they are basically the new capital pools. Once upon a time, investment banks and banks, they were the source of capital. Tier 1 capital now doesn't go to risky things. They don't write the checks that they used to. They're back to more basic banking model. And all of these untaxed pools of capital that have grown so substantially now are the new game effectively in town. And that is why these pools of capital, as Britt pointed out, and he's absolutely right, this becomes a critical source of funding for global infrastructure, global projects. And I think it's something that we still have to come to grips with, how this capital is getting deployed. But it could be put into infrastructure to really sort of take the North American economies to a whole other level. Nobody seems to have harnessed that yet, either in the Canadian context or in the US context from my perspective.
That's a great point. Hero, yeah.
Well, we are very new to alternative investment, and we received approval from our investment advisory committee, which is equivalent to board, to make alternative investment up to 5% of our total fund. So we are talking about $70–80 billion. So, but I received the mandate as a cap rather than allocation, which is very, makes a huge difference to me. Because in my opinion, alternatives, I agree with the Jagdeep, it's an opportunity rather than the sort of a set allocation. So when we see the opportunity, we will find the alternative investment to alternate the other traditional assets. I think there's given the supply and demand imbalance in a particular area of alternatives, I think it's a bit risky for us to feel like we have to allocate a certain percentage to alternatives. So our approach, my approach toward the alternatives for the time being is we just see the opportunities, and if the opportunities are compelling, we'll just do the alternatives, but we have enough, the budget to do so. And individual, the sub-asset class within the alternatives that we started from infrastructure investment, as you just described, that we teamed up with the Canadian pension to set up a global infrastructure investment platform. For the real estate and the private equity, we are still, collecting ideas how to write the blueprint. But that's my approach toward the alternatives. And when it comes to the risk management, again, there's a lot of much more sophisticated pension fund managers in the world. So we try to pick their brains. And we also received a lot of the risk management tool proposal from the service providers. And all of those looks scientifically or mathematically beautiful. But sometimes I just have some genuine doubt whether such a technical risk management tool is really helping us to create the optimal portfolio. So I don't want to forget the sort of a bit intuitive, it sounds primitive, but the sort of old traditional, the strategic, the asset allocation is like a backstop so that how we think the risk. But in the meantime, we're definitely trying to incorporate the new, the risk management tool, like a total portfolio management and et cetera. But I think the balance is very important. We don't want to be too, too beautifully manage our excuses.
So
can I say that?
courage and IQ.
I just want to add to what Hiro said. There's so many numbers in investments that we tend to think of it as a science, like it's physics, like there are laws. There are no laws. The apple does not have to fall from the tree. It can go sideways. It can even go up. There are only probabilities, and we treat them like laws. And there's a big difference between risk management is still in its infancy. This whole concept of really this kind of risk management didn't even exist 20 years ago. It's a very early stage stuff, and most of what people call risk management is really risk monitoring. I have the good fortune to work with Chase Abbey, who's our chief risk officer, and he just got awarded the chief risk officer of the year for the entire United States. And he constantly reminds me that there are bullet to the brain risks that you need to concentrate on. Bullet to the brain risks. There are only 3 or 4 of them. Excessive leverage, excessive concentration, excessive illiquidity, and then finally, of course, the most important is your own reputation. And those are the risks. You have to manage those risks. The other ones you're just monitoring, and then and then you have to use judgment because it's not physics. With regard to the other thing that because we are the strong hands, to your point, one of the things that the first thing everybody should study is market cycles. That should be course number one. They're just repeating cycles over and over again, and they're pretty, you don't know exactly when they're going to happen. You don't know exactly how long they're going to last or how far they're going to go down or up, but you have a general idea of what's going to go on, and you pretty well know that after a decline, there's going to be a recovery and then an expansion. And so so you make your boat. So there's two times that you're investing. One is you have to rely on IQ. So right now we're in an IQ period. Like there's not a lot of really amazing values anywhere in the world, and you got to fight for every basis point. It's all about IQ. And then there's certain points like the end of 2008, early part of 2009, where it's not about IQ at all. It's only about courage. And of course, if you have a long-term time horizon, you don't have to be right in the next 3 months or even the next year, and you have the liquidity, and you have the agency structure, at least the amount of courage that's required is reduced. And that is when we have our greatest advantage. So you need to know whether you're in an IQ market or a courage market. And right now we're in the IQ market.
Go ahead, Jagdeep. You want to jump in?
I just wanted to add that, I think about risk management in our types of organizations more as a cultural issue.
Yes.
So, we all tend to think that we're asset managers, but I firmly believe that we're risk managers more than we're asset managers.
That's right.
To begin with. So I think every one of us should state what our beliefs and our values are. I'm not saying today, but as an organization. And I think that should drive how we make choices and investment decisions. And for me, one of our strong beliefs is that we are risk managers first. So that's a cultural issue to begin with that you need to translate practically across everyone in the organization. Secondly, I think Britt is right that this is still in the nascent stages. I would say more so in terms of implementation. The theory and the practices are well established, but I think after the last global financial crisis, many organizations for the first time just started to put better risk systems in place. But having said that, I think today, we can do a couple of simplistic things. We can measure, for instance, our value at risk, or we can stress test our portfolios to see, based on previous crashes or crises, what could happen. But I think when you think about the risk that maybe some of us are worrying about, which is sort of another, firm or another sort of crisis type event, in that type of scenario, whether it's market risk or portfolio risk or liquidity risk, all these things become very connected very quickly. And sort of in this crisis type risk event, the contagion and the cascading of these effects coming together for even the best portfolios that were greatly constructed, that met the investment objectives, everything starts to sort of look interconnected. And I think today, at least in the last 5 years, there's been a lot of discussion here about liquidity risk, monetary policy risk, right? These types of things, how do you actually start to incorporate these into whatever the traditional practices have been in your organizations? And in that context, I would say that there's an opportunity for all of us to collaborate together. I think we need to start crowdsourcing risk information amongst ourselves. We need to start looking at what is the liquidity in the system, not just in our own portfolios, because that interconnectedness amongst us peers. So that one of the things we're doing now at the University of California is I'm getting everyone to think as risk as a culture, and then focusing on how we can collaborate with our peers to better understand not just what we're doing in our portfolios from a risk perspective, but how can we gather and crowdsource risk information? Being in Silicon Valley, you could imagine we could do things like this, right? And try and instruct us on what that means for our portfolios to think about those crisis level scenarios. So that's my view on risk management.
Let me pick up on the liquidity theme, because I think most panels over the last 3 days have talked about liquidity concerns. And it's not hard to envision the scenario with less market making, central banks buying fixed income assets, that the pool of liquidity is shrinking. And people worry about that. And I worry about, the question that comes to my mind as I listen to this discussion, is that a moment for courageous behavior if something's to happen? In a world of patient assets, if there is a liquidity crunch, and some would say it's likely, what's the role of the patient capital in that?
I'll make one brief statement. So obviously, if you're a liquidity provider in a less liquid world, then your opportunities are higher. but you got to be fast.
I think the liquidity discussion it's still a debate. One thing I can say is that Basel III in the banking system basically pushed liquidity out of the banking system and out into private hands, effectively, is what it boils down to. And I remember a bank governor saying very recently to me that we wanted to get liquidity out of the banks and into the hands of the private companies. And they have to learn how to manage their own liquidity going forward. Teachers, we really focus in on liquidity management because some of our exposure comes through swaps and derivatives. So marking to market is critically important in another 2008. And so there is a program around that. So there's a big liquidity risk. Just adding on to a couple of points here a minute ago around risk also, just to another level of it. Given that we are global and have invested all around the globe in 40 countries, another conversation around risk comes from our board of directors. And what they see when we're investing in emerging markets and other things directly, what governance model are we actually putting in place around that? Risk management around the brand and the reputation that you have as well is a whole other conversation that's taking place. As you move into alternative assets and start owning them more directly, that actually has an impact and can come back to the owner of the company, which gets us into a whole other conversation about managing risk. And it also starts speaking to, when you own these assets, the kind of talent you have to bring in. It's not one thing to just buy a company. Now, if you're going to own it for the next 20 years, like a train system, you better have operating expertise to be able to manage it for the next 20 years. So risk comes, and I agree with Jagdeep, risk is critically important. It's a cultural thing, and it's omnipresent from the board all the way down and through everybody in the organization. It has to be.
Go ahead, Jagdeep, yeah.
I think you asked about talent earlier, and you brought up the talent question as well. I have to say that, you know, for the young talent out there in the world, I'm not sure they've really thought about, after graduating, going to a permanent capital pool. I think we think about investment banks and consulting firms and private equity firms, but I do think that each one of us and our organizations, and frankly, the hundreds of others out there, are phenomenal places to have a career. And the reason I say that is because you've got access to permanent capital, you've got a perpetual capital pool, and you've got a global opportunity set. And frankly, you know, whilst it is challenging, and each one of us have our own constraints, and that could be pay or governance structures or hiring practices, but if you figure a way to work through those challenges, I think what ends up happening is you can have a phenomenal platform to do some very interesting things in terms of opportunities. And what has worked for me in terms of talent, and I don't look at the talent equation as sort of, you know, direct investment capabilities or indirect. I look at it as sort of gray, green, and grounded. And what that means to me is I'm looking for the green, super bright, super talented people that are really successful wherever they might be, but we can give them a bigger sandbox to play in. And that's the green part. And I think you can make it really exciting for them. You need to give them a mentorship opportunity. And I think that's where the gray comes in. I think there's some incredibly talented people who've had a very successful career, but they've retired and they don't want to keep playing golf. And I think they want to come back and be a kid in a candy store. And in that context, coming and joining an organization like ours to take us to the next level and make a real difference for the missions that we're all part of is that gray part. And I think if you marry the gray and the green, you create this mentorship opportunity that's pretty unique. And the grounded part, and I think that plays to all of us, because, you know, Hiro is the new hero in Japan, and he's got his own exciting opportunities, but he's got his challenges in terms of how he's going to attract talent. But the mere fact that somebody may not have had an opportunity as big enough in Japan to go and do what Hero can offer them to do is the grounded element. And I think that's where California is a phenomenal place to attract talent. So I come from Alberta. That may have been a bit more challenging in Edmonton. But having said that, I think you can still give an amazing opportunity set to people. So to this question of talent, I do think the opportunity set is very exciting just in terms of, and it's not just for us. I mean, you can go to Abu Dhabi or you could go to any other part of the world, but I think you can really make this a worthwhile career for the next 5 to 10 to 15 to 20 years.
Take another minute and talk about the program you have with the university system, the capital pools that you've set up for innovation and ideas, just as a mechanism for creating innovation,
Sure.
deploying the full scope of essentially your students.
So the University of California has 250,000 students, 250,000 faculty and staff, and when I came on board, the very first thing I was told is we had operated and acted as an isolated unit off the University of California, and I thought that was actually a huge opportunity for us to be part of the University of California. So when we think about that, and we think about what might be the opportunity, so we keep chasing alternative assets or emerging market opportunities. To me, I think when you think about the United States, it's the best emerging market for infrastructure. When I think about innovation, where else would you be on the planet than being in Silicon Valley? And then when you think about half of Silicon Valley, where the University of California operates, and the fact that we could do more to help with the commercialization of innovations that are coming from all the research we do for the rest of the world, I think there's a unique opportunity there. So we've worked with Sand Hill Road for a long time, historically. And what we've made a commitment to do is put aside a $250 million UC Ventures Innovation Fund. But it's going to be at arm's length from us, and that's to deal with a lot of the governance and issues that we talk about. And I think it's an excellent opportunity for us to invest alongside, not crowd out, but crowd in Silicon Valley and partner with them as these opportunities arise across our 10 campuses and 5 medical centers and 3 national labs of energy. So I think the question is, I mean, innovation is one example, but I think each one of us need to ask the question about what are the competitive advantages we have in the endowments we have that are really unique to us. It could be geography, it could be sector, it could be industry. But if we understand those and we exploit them to our benefit, I think it creates the opportunity set. And that's not about an alternative. I mean, that becomes the mainstream of what we end up doing.
Yeah, so there's no question that we have the capability, and we should have the strongest investment organizations really in the world. I believe, and I'm highly biased, we have the best investment organization in Texas. I don't think really any objective third party could counter that, and we should. But you do have to deal with some things first. You have to deal with compensation. Mm-hmm. You have to believe that the people that you're serving deserve, A players, not just the cheapest player. You have to deal with the culture. It's got to be an investment culture. It can't be a government culture. It has to be an investment culture. You have to deal with your agency structure. No great investor is going to come to an operation where he or she, is not the primary investor. You have to deal with those 3 things. And once you do, then everything that you just heard about, these are the best investment jobs in the world by far, on the biggest platform, making the biggest difference. And then, each person that has their additional thing. We have what we call a come home to mama strategy, which is we just reach out to every Texan, that's located in New York City at the end of a cold winter and just had their first child, and they just come streaming back, which is a very useful and I highly recommended strategy. But just don't go after the Texans that they're out.
Let me kick the conversation up a level and talk about governance. We all work for boards. There are good practices and there are best practices. Janet, I'll start with you because you've moved the needle, it sounds like, with the governance in North Carolina. And you might comment on that. And also, just for the panel, what constitutes best-in-class governance from a board standpoint, given the mission of these collective organizations?
Right, so I am a sole fiduciary, which when I fully understood, I was running for this office and I fully understood that, I thought this must be some vestige of the 18th century or something, like what, but it was actually the 1970s. So, macrame, discos, and sole fiduciaries coming out. So it's probably not that, a best practice. I certainly understand why people question it. It has worked well in North Carolina. But to address the concerns and think about, is there a new way of doing this, we did put together a committee. That's what every politician does. You put together a committee. But they couldn't agree amongst themselves. I was actually very surprised that there was no consensus that they should move to a board. And maybe the general consensus would be a small number of investment professionals with no conflicts. That's no easy thing to get, but insulated from political pressures, able to have that investment culture that Britt talked about. That's probably the ideal system that maybe a few folks across the United States have.
Janet, keep pushing. That's exactly what we have. Keep pushing, because you can get there, and it does make a difference.
Well, and so we have the concept, and it's on the shelf, and when they are ready, and I don't blame the legislators in North Carolina for saying we're 95% funded, you know, we're giving you some resources, you're improving incrementally, why should we make some dramatic change right now? And so there's just not an appetite to do that, but it is there when the time is ready, and that politics is always like surfing. You have to capture that wave and know when the time comes. It is there, and I think, you know, at some point in North Carolina, they may make that switch.
Hero.
Well, as you probably know, that there was a lot of debate around the governance structure of GPIF, and it attracted a lot of media attention. It created a huge political debate. One thing I would like to share with you is that the difference between Japan and probably with Canada is that Japanese government guaranteed the sustainability of the pension system for the next 100 years as a DB. So I think we'll probably be the last standing DB in the world in 100 years' time. So it's not like like Canada, if they fail to invest well, the pensioners' contribution has to be have to be risen, so have to be increased. So I think that every system, depending on how the public pension system is structured within the social benefit system, I think they probably dictates what is the most ideal governance structure. But one thing I've been always wondering is that as far as my observation on the U.S. public pensions, I don't see the very strong correlation between strong governance and high transparency and the number of scandals they have. So,
Right. Yep.
So, and also I realized a couple of our peers even broadcast board meeting, but that ended up in they don't discuss much because they don't want to be broadcast the real, the real meaningful discussion because they may create the public debate. Yeah. So that's something I think the stronger governance, high transparency, it sounds great, but what really happens probably has to be discussed in the context of what kind of culture the organization has, as well as how the system or public pension system itself is positioned in the whole fiscal system. So it's a very complicated discussion, and that we are still going through a lot of debate. And I'm very keen to learn what you guys have experienced. But it's not very easy to say it's better to have a strong governance, but in a practice, it's actually quite complicated.
That's so right. Yep.
Ron, the Canadian pension plans, I've always viewed, sophisticated, good governance. How did that come to be? How would you describe it? And I also want you to drop into another subject, which sometimes is controversial, and that's sustainability as an investment theme.
So Ontario teachers back in the 90s, the governance structure was set up by the teachers of Ontario and the province of Ontario, but part of the architecture of it came from the Janet Yellen equivalent in Canada at the time, Gerald Bowie. He sat down and said, if we're going to run this, we're going to run it like a business. We're not going to have political interference. We have one focus, and that is to focus in on paying pensions for generations to come. We will not have teachers' union interference. It will be completely separated from the two. It's not part of a negotiating or bargaining unit thing. It's its own thing. And they appointed 8 board members, 4 from the teachers, 4 from the government, and they are former CEOs of banks. They are COOs of banks who ran risk management operations globally. Very independent, sophisticated board. Governance is one of the things that Teachers Kicked Off is known for. Now, if you look at all the other large plans in Canada like ourselves, they're DB. A lot of them are in surplus. And quite frankly, we market our discount rates down at 275, in fact, right now, real, and we're in surplus. This governance model has really allowed flexibility in pay, flexibility in all kinds and aspects of governance. So when I think of us and our diaspora, because CEOs of other plans in Canada came from teachers, and they've followed that model. And as they bring in new plans, they're continuing to follow that model, and it works. In terms of sustainability, what we have is a defined benefit plan, and that defined benefit plan is an evolving plan. In other words, every 3 years we have to show up to the government and show it that we are completely in balance. With a surplus, can't have a deficit. What that really does for us is we work very closely with the members, and we will change the terms of the plan, actually. It's actually allowed to breathe. And that's been a big, huge innovation that the teachers of Ontario have come to the table, because they recognize that a plan, in order to be sustainable, has to be affordable. And as right now, the oldest person in Canada, who just passed away a week or 2 ago, is 112, is a teacher. And interestingly enough, the teachers in Ontario live 5 years longer than the average Canadian. And
Less
so,
pressure at work.
So as they get older and older, we've got to pay pensions longer and longer.
Sure, yeah.
So there's a huge, strong governance culture, and there's a very important sustainability argument that goes on constantly in our organization.
Right. And the ESG question, the importance of that in the world of your firm's high, low, medium, longer term, shorter term, how would you position that?
We talk about it as long-termism. I mean, again, I'm publicly elected, and I think Britt was talking earlier that, you know, he wasn't elected to solve climate change, and he's from Texas, so that's probably a good stance. Also, North Carolina, conservative state, so you don't start talking about sustainability or social impact. I do think folks understand a long-term alignment with the interest of the state, that my pension is going to only be as strong as the North Carolina economy, and that things like an innovation fund that is about investing in your own backyard and investing in the spinoffs from our great university system in North Carolina, they get that, they are supportive of that. It's all about fiduciary return, but if there can be some good on the side. Emerging manager programs where we look at the demographics of North Carolina, about 25% African American, a growing Hispanic population. How are you going to bring that population into being the money managers of the future? So emerging manager programs have been something that we've done in both our public equity and soon private equity portfolios. Those sort of long-term alignments with the economic prosperity of your state have been important.
Jagdeep?
So I'm in California, and we talk about the climate. We talk about water, we talk about energy, and we talk about new energy. And I would say that being a university, and there's a huge movement, not just here, but all around the world, on the question of divesting from fossil fuels. And I don't think we can ignore the question. I think it's a very important question. We have 250,000 students and 250,000 faculty and staff. We have some of the best researchers on the planet that are studying this topic. So we have to respond to it. We have to think about it. My view is, one of our beliefs is we're a long-term investor, 10 plus years. And if you're a long-term investor, absolutely you've got a fiduciary responsibility for our pensions and our endowments and our working capital pools to maximize return per unit of risk. The trick is per unit of risk. And in an investment decision-making framework, as a long-term investor, you have to think about these risks. Because if you're investing in any type of asset, whether it's a real asset or other assets that are impacted by what we're talking about as fossil fuels or energy, I think these risks can manifest themselves in a way that can impact the financial values of your assets. So for us, I don't believe it's about ignoring the issue and saying we're a fiduciary. I think we have to embrace it, but we have to think about it in our investment framework. And I think we have to have broad environmental, social governance type policies in place, and then think about these things holistically. And I don't think you can be a leader today in any one of our seats and ignore these issues. It doesn't have to stop at the climate. There's all kinds of issues, but we have a responsibility to be proactive in thinking about these things.
Thanks, David.
Can I say something?
Yeah, go ahead, Hiro. Just
About ESG, we put the ESG in our 5-year business plan. And I do understand there's a lot of debate about the fiduciary duty and et cetera. But in my personal opinion, our professional responsibility is on the top of our social responsibility. So, and as we are the pension plan, which should be sustained over the next 500 years, I see no point in receiving full pension benefit in the environment. The temperature is 110 Fahrenheit. So, so I think it's my personal opinion, obviously, but I try to just find out the good balance. And in my opinion, our professional and fiduciary duties, obviously on the top of they are social responsibility as a good corporate citizen, a good global citizen.
great.
So, just to give, I've got to give one small. You're hearing from big government states. We're a small government state. I'm not employed to express my personal opinions about things like this with other people's money. I'm employed to maximize their return within the risk parameters that I have.
And it seems like you're doing a pretty good job at that. So I want to ask you to put your hands together and thank these panelists for a lively discussion.